All right, everybody. Welcome. Thanks so much for joining us here today for this Opendoor Q3 earnings discussion, AMA, and then also having the opportunity to discuss Q4 guidance, the current state of residential real estate in the United States, including macro, the iBuyer product, and recent announcements from not just Opendoor but also Redfin, OfferPad, Zillow, kind of the big four prop tech publicly traded firms that are navigating unprecedented macro headwinds. I think it's probably important to just sort of set the table for what we might talk about today. I think there's certainly plenty to discuss regarding earnings, as all four of those companies have recently reported earnings, and they're all sort of troubleshooting this environment a little bit differently. I think that there's also a lot of fodder to be discussed with regards to Opendoor's new third-party announcement, and then also sort of how Opendoor is performing as forward-looking as possible in their current markets. And so I think nothing's really off the table. We might not be able to answer everything, but would love to sort of get us kicked off if anyone has a specific question. Otherwise, we can just sort of start tackling item by item.
Feel free to request to speak if you have a question. Otherwise, we can maybe just start with a quick summary on the Q3 earnings.
Yeah. So starting off at a blistering pace, just like we did last week. All right. So just to kind of give you guys an idea, high level, how we approached Opendoor's earnings announcement. I think on the one hand, revenue obviously came in big top line beat, whereas bottom line there was a big loss, and then on top of that, obviously there was the nearly $1 billion net loss, which included more than $500 million write down on inventory. And so I think the way that we looked at the quarter was relatively in line to our expectations. And basically what we saw is that Opendoor accelerated the velocity that they sold off that Q2 home cohort so that they could get back to neutral. And so I think a lot of the sales they originally expected to go in Q4 got pulled into Q3, and those are low margin sales, which is why the bottom line there was a miss. And then Opendoor doubled down on that. So they decided to take as much pain as possible in Q3, which meant that they decided to take all of those potential write-downs, including a pretty pessimistic view on market macro and sell-through, to arrive at that $573 million, I believe, inventory write-down. And so I think what we saw is that for the GAAP gross margins, that brought it down significantly, right? Almost 1,600 basis points. But I think what's important to remember is that what that also means is that it leaves relatively unopposed upside for the Q4, Q1 quarters. And so although adjusted gross margins are going to be fairly weak in Q4, I expect GAAP gross margins to be higher because of all of the actual positive inventory that Opendoor has that are going to make money on the resale relative to the write-down inventory that they added to their balance sheet in Q3.
With Dave up here. Dave, do you have a question for us?
Hey guys. Thanks, Tyler and Sebastian and Data Routine. Can y'all hear me?
Yes, we can hear you.
Okay, awesome. Yeah, I guess today's price action was kind of interesting. It was nice for those of us who are holders and long. We've been tracking. A lot of us have been kind of tracking what's happening with yields and rates. And I think when we start to think about what's going to happen with home prices, and we look at where interest rates have been going, and today's kind of drop in interest rates, I think is going to be great for the remainder of Q4 to maybe give a little bit of an uptick to try to maybe, I just personally, that's how I see it. If anyone was looking to buy and they were on the sidelines after today, I mean, if I was looking to buy, I'd be really looking to buy. You know what I mean? I don't know. I'm just trying to think, if you're in the market, now you're really in the market. But I don't know. I'm wondering if y'all have any thoughts about that. But just like you said, I mean, I just kind of see there at some point being a pricing floor also due to inventory. Home builders are talking about slowing down housing starts going into 2023. And, I guess my question would just be, is there any kind of, it's not exactly towards the actual quarter numbers, but are there any kind of just thoughts on a little bit more thoughts on the macro that y'all might have just kind of in general as you see, okay, they pulled forward a lot of the losses. That's awesome. We see that they sandbagged Q4, that probably means they'll be looking better for Q4 when they report it, right? Potentially. But I think today's events in the market is a good sign, but I guess that's a few different thoughts. I'll shut up now.
Dave, thanks so much for kicking us off with a question. I really appreciate it.
Yeah, sure.
I think you kind of touch on some really interesting elements of what we're all watching for 2023. I do kind of want to sort of set the tone a little bit with regard to macro. I think Opendoor has sort of demonstrated that the macro, particularly rapid macro changes, are difficult to predict, and potentially leave the company vulnerable. I think on that axis, the only area that Opendoor is vulnerable is fast move from hot market to down market, right? So a fast move from down market to up market is going to be really good for Opendoor because improved sell-through rates, and they were already conservatively positioned, so margins balloon, right? But in this one situation where you go from really hot market to really fast down market, that's where Opendoor is particularly vulnerable. And so I think to your point, whether or not, mortgage rates slightly improve or if they slightly worsen, I think the biggest threat to Opendoor is that they go out of business. And so if we think about it in that context, then really we just need to get back to a relatively more stable macro environment. And if we can do that, then the company navigates those headwinds effectively, I believe. And I believe that because I think historically they've really done that. First half of 2022, they were profitable from an operational perspective. That was an up market, which I think apologists might say isn't really a fair example, and perhaps it's not. But I mean, going back to that sort of axis of strength for Opendoor, in a really hot market, Opendoor's product doesn't really make sense, which means that they have to make offers on homes for more than the home is worth today to maintain conversion. And so I think this all goes back to the central thesis of, or the newfangled central thesis of Opendoor's product market fit is most aligned, is most in resonance when the market is neither moving very fast or is not moving very fast in either direction. It's more just stable. And so once we reach that point of stability in the housing market, which I think 95% of US housing moves at, Opendoor is able to sort of return to dominance. And that's really what I'm looking for, is not so much where a rate's going to end up or, at what level will it kill the thesis. It's how do we get to a steady state where big moves can be avoided? Because once that happens, Opendoor is sort of insulated from a lot of that downside risk.
I might add to that historical drops, like the mortgage rates today dropped by 0.5%. Is like the largest drop ever recorded, I think. They're not necessarily great for Opendoor either, because a lot of buyers are probably staying on the sidelines and thinking, yeah, is it going to drop further? Is it going to back up again? Like most people, if there's rapid change in something, especially something like the mortgage rate that will dictate your payments for the next X years, they want to make sure they make the right decision, and volatility is not great for that. That being said, sharp drops are definitely better as sharp upswings, right? Because buyers are looking for lower mortgage rates. So if it drops, we should see higher volumes in the next few months, but it might still have a short-term negative impact. Kartik, do you have a question for us?
Yeah, can you hear me?
Yes.
Okay. Hey, Sebastian. Hey, Tyler. Just a couple of questions and thoughts. So the first is, I'm surprised, and please help me if I'm misunderstanding this, but if there is another rapid downturn in the market, I'm surprised that Opendoor would still have faced the similar kind of trouble that they did in Q2, because to me in Q2 it almost seemed like they were caught up in the euphoria as well and didn't react fast. I think if it were to happen again, they would probably go risk off much sooner and reduce the downside risk, right? Of course, the upside risk minimizes as well, but I don't see why they would react in a similar fashion, unless, of course, they make a big mistake again. The second thing to me is there's a lot of chatter about bankruptcy, but uh, I think it was the CFO on the call who mentioned that they have clear line of sight into additional financing as well, and it was pretty, uh, yeah, it was pretty large amount. I'm forgetting how much it was, but yeah, just wanted to hear your thoughts on both of these things, and of course, continued disappointment that Eric doesn't communicate much. I mean, I think in times of recession, like times like this, it'd be great if he communicated much more. But yeah, that continues to be a disappointment.
Hey, Kartik, thanks so much for the questions. I think in response to your first question about whether or not Opendoor would lose a similar amount of money if these events repeated themselves. When I said that in my recent article, I was referring to if the events of 2022 repeated themselves. So we went from this super hot real estate market to a very fast down market, because the delta between what a home is worth in a 3-month period in those circumstances is massive. And so that's one part of it. But also, I also just believe if we, next year, call it June, and the market is returned to normal, and housing suddenly drops 10% in 2 months in several of their biggest markets, Opendoor is going to lose money in those markets, and it's going to take 6+ months for them to recover in those markets. That's just the dynamics of their business, and to sort of follow up on that, I've never really discussed that as a potential risk factor for the business, because it's almost never mattered before, right? Like it's almost never been, those characteristics or those variables have never really been introduced into United States residential real estate, at least in modern history. And so, I mean, I don't want to make excuses or, for my blind spots and in ways that I've gotten the thesis wrong for the company. But I just want to be clear. If housing market drops 10+% in 2 to 3 months, Opendoor is going to lose money in those markets. It's not protected against that. And it's even worse if it's a hot market where they're paying more than a home is worth to convert. And then suddenly, it turns the corner because the delta is bigger. So that's a part of it. That said, all of that said, and this is sort of the ultimate purpose or design in my recent article, is if you start to add in that third-party marketplace, the economics change completely. So for example, I ran the numbers based on what I would expect the third-party marketplace and Opendoor exclusives to account for in regards to contribution profit, and I put in those dynamics and repeated Q3 2022, and Opendoor loses $300 million less dollars. So the assumptions there is that 20% of Opendoor's Q3 transactions were via the third-party marketplace. So they just collected the fee, paid 2% back to the, the customer, had 80% attach rate, and then 10% of their transactions were first-party Opendoor exclusives. And in that scenario, Opendoor loses 300 million less than their 928 million. So it's better, right? It's better. They still lose money, but it's more insulated. And the higher you ratchet up that third-party marketplace share, the less money they lose. Because maybe I'm jumping ahead a little bit because no one's really asked about this yet, but when you think about all of the issues of Opendoor's business, their razor thin model or margin model, their the fact that it requires so much debt, so much capital, that there's HPA and HPD risk, all of these sort of concerning features for this to their business model, they're all kind of eliminated or satisfied by this third-party marketplace model. And that doesn't mean that the third-party marketplace replaces the first party, because at the end of the day, the intense product market fit that Opendoor has with the seller, with the home seller, with their first-party product should exist, and it should be an option for home sellers everywhere, right? Like, period. And full stop. Their first-party product should be available to anyone who wants it, who's willing to pay a 5% liquidity fee. And I think their NPS score sort of demonstrates why that's so important to be maintained. But also, from an economics perspective, you need that first party business and that operational muscle to be able to seed that third party marketplace to aggregate both supply and demand. And so I think moving forward, the third party marketplace is going to be a material part of their business, and it should be the best part.
Yeah, that makes a lot of sense. And I wonder if Opendoor also needs to come up with this is in some ways a black swan event, so I don't expect these sort of black swans to keep happening in terms of the speed at which housing has been going down. But I think Opendoor probably needs to come up with a hedging mechanism as well for when such things happen, because you're right, 3P does shift the risk profile quite a lot, but still 1P will be a decent part of their business. And I just feel like they should probably think about maybe rentals or some other way to hedge these scenarios. And so far nothing has been communicated, but yeah, I'm just curious about what they would do though.
One thing that is quite interesting to think about, and I think Thomas tweeted about it somewhere, is the role of the first party offer that Opendoor gives to sellers will change quite a bit when they have their first party marketplace completely rolled out. Because sellers come in and obviously they see the cashback offer from Opendoor, the first party offer, immediately. The process is still the same. But then what kind of Opendoor optimizes for is that as many sellers as possible try to list on the exclusives page for 2 weeks and get additional offers. And ideally, in that case, they want those additional offers to be higher than their cash offer to convert more people to their third-party marketplace. So I think in the future, if we have a really hot market, Opendoor can still drive a lot of demand for their service, but maybe not overbid too much on those first-party offers, because they have still the third-party marketplace around to give higher offers if the home is worth more. So I think the dynamics of this first-party offer will change quite a bit as we go, obviously now in the down market, then again into an up market at some point, with that broadly rolled out. So I wouldn't expect the next if this situation repeats, I wouldn't expect to be all the variables to be the same. It's and hopefully Opendoor learned a little bit out of this and incorporates maybe the speed of mortgage changes a little bit more into their model and go a lot more risk off.
Yeah, and in some ways, I think this could help as well, because I think they might focus more on margins going forward, and I think bring forward items on the product roadmap that reduce risk. So while it looks horribly bleak right now, in some ways, I think if it survives, there's a lot of good things that might come out of the situation.
Tyler, do you have something to add to that? Otherwise, I want to go into that one point that we also discussed, that you also discussed in the article, is one argument that I read on Twitter all the time is that Opendoor realized their iBuying business is not working. That's why they're pivoting to the third party marketplace. And that's, I think, not accurate. And um, I think it's important to kind of call out the history of how uh, Opendoor arrived at that third party marketplace that we will see roll out in the next few months in more markets. Um, I think that the important first step that they made is this was back in 2019 or earlier. In 2019, we first heard about it in the interview that Eric gave on the PropTech Summit, is that they have and I think they called it already a marketplace, that they have an institutional marketplace, a closed marketplace, where they connect buyers and sellers, and also offer their own home zone to institutions. And that's kind of what manifests itself with the institutional sales that we can also observe, which uh, I think they called out on the earnings call that it's about 10 to 20% of their business. So that kind of started in 2019. And now last year, end of last year, again, as a reminder, that's when the market was still flaming hot, and Opendoor was buying the homes that then produced rocket profits in Q1 and Q2. They started Opendoor exclusives, where they started to list their own first party homes on their website, so that consumers can buy them directly from Opendoor without an agent, with a buy now price, a simplified checkout experience. That's when they first started experimenting with it. The first homes that we recorded were listed back in September 2021. And they went through quite a lot of experimentation. They started in Austin. They started listing a low percentage of new homes on exclusives, and they pushed it up to like 30%, up to 100% of all new listings first were listed on Austin, in on exclusive in Austin, and that resulted to like a share of all Opendoor sales in Austin of 30% that went for exclusives. That is the record that we recorded earlier this year in July, and it was kind of between 25 and 30% in all of Q2. So I think that's where they really got confidence that this direct to consumer model in home sales can work. And from there, they started the work on the third party marketplace, where sellers that are coming to Opendoor to get an offer, they will let them list on Opendoor exclusives and sell them without Opendoor actually ever owning the home. That's where they are becoming a real marketplace that never owns inventory. And that's where we are in right now. We have 9 third party active listings. It's still quite a lot, a small number. But from here, Opendoor is going full on to the vision of listing their own first party homes first on exclusives to drive demand, and allowing sellers to list their homes as well. And then either getting a higher offer from third party buyers that the seller can accept, or take the first party offer from Opendoor that is still there to back up the third party marketplace.
I think just to sort of dovetail on that a little bit, I think it's also important to recognize that this is another one of those situations in residential real estate where you're just like, why isn't it always like this? Like, why, when you have to sell your home, aren't you able to list that home and, for no pressure, get a
offers from a bunch of different people, right? No showings, anything like that. All you need is some basic information, and you right off the bat have offers that you can choose to take or not take with no commitment. I mean, I think it's the best expression of what the home selling process should be. And Opendoor has historically nailed the sell side equation, with their original flagship product, and now with this third party marketplace. But I just think there will come a time, and that day is not too far from now, where it just wouldn't make sense to not list your home on Opendoor first, or get offers from Opendoor's massive network of buyers first. And so as Opendoor stocks the proverbial pond with its first party business, this third party business has the opportunity to do contribution profit margins in the 60+% range, which is, roughly 12 to 15 times higher than their first party business. And I don't think one replaces the other, but really, when you start to look at that and the economics of what the marketplace model is, it's easy to see that's the best version of the business with regards to longevity, shock, or insulation from black swan events. And so, while it's not a pivot, going back to sort of the original question, I don't think it's a pivot because they've been talking about building this marketplace since their Series A pitch deck. I do think that they brought it forward because they realized that they need to get lean, and they need to improve the unit economics, because it's going to be a tough year or two ahead, as all tech companies are sort of perceiving this, and particularly prop tech companies. And so I think in times of crisis, the old expression, chaos is a ladder. It's the best prepared company that comes out on top, while the others sort of dwindle, die, or implode. And that's what we saw with Redfin, which is something that I've been talking about for over a year now. That's what we saw with Zillow literally a year ago. These are just companies that were doing iBuying as weekend warriors, and it's just not. It's not a safe space unless you're fully focused on it, and even then, it's not safe if you have the right macro circumstances.
And talking about every seller getting an offer from Opendoor, both now that Redfin stopped iBuying, they also announced that they will send all that iBuying traffic to Opendoor. So Redfin and Opendoor already had a quite deep integration to request an offer from Opendoor for a while in all the places where Redfin now was not available. But I think what we heard now on the earnings call is that basically all iBuying funnels are going to go to Opendoor for Redfin.
All roads lead to Opendoor.
And we also heard on Zillow's earnings call that they are making progress with the Opendoor integration, and it's something they are going to launch in Q1. So both of those things should drive more sellers into the funnel and help them improve conversions on their first party offers.
All right, who else? Who else has a question?
That I can go again, if that's okay.
Let's do it, Dave.
All right, cool. So I think, all right, so exclusives. Well, let me take a step back. So we see what happened with Q2. As we've been kind of post-morteming that for the last several months in the Discord, they have to solve two problems, right? They need to solve for better unit economics, and they need to solve for volume. Pricing strategy, from everything we can see, right, it seems like they've solved that problem with their updated pricing strategy since, what was that, July, early July or late June, or was it early June, roughly in that time frame. Then second problem, volume. We saw from the Q2 earnings call that the Zillow partnership was announced. None of us knew when that would potentially go live. Now we know, based on Zillow's latest call, that that's looking like Q1 2023, which will be awesome. But I feel like, and I think we've had some discussions here, but I personally think, and I know based on what some things that we've seen from Del Preet, it's potentially quote unquote a 10x funnel over what Opendoor's used to seeing. So if you solve the volume issue with the Zillow partnership, I mean, that's huge, right? You're solving the two problems that you needed to solve to make all the money, to make everything work out financially moving forward. Even in a down market, even in whatever market we're in. I mean, I feel like if you've solved the unit economics and the volume, then you're solving the problem. Now we're talking about exclusives is, to me, the cherry on top. It's the ultimate, and Tyler, you had that article, what is it? The game of homes, or it's basically, that's the ultimate destination that they've been leading up to. And, one of the questions that came up in the Discord within the last several days or week was, it seems like they kind of rushed into that. It's like, no, not really. I mean, but they said originally that they wanted to launch that in 2020. We all know what happened in 2020. And at some point, they have, it's probably been sitting ready to go, ready to launch. It's just been a matter of kind of tweaking and getting additional testing and, in your pilot markets and all this. But at some point you have to pull the trigger and launch, right? So I guess I just feel like exclusives is kind of like the game changer aspect. The Zillow partnership solves for volume, and the new pricing strategy solves for the unique economics. And so I just, if there's any additional commentary on any of that.
Yeah, I think you bring up a really interesting point with regards to funnel. But just to take a step back, with Opendoor in 2022 was on track for well over 40,000 home sales without the Zillow partnership, right? And so 40,000 home sales is a tremendous number of home sales. I mean, I don't think there's any company that's operating and reselling that number of homes ever, period, in a 1 year period. So I think their funnel is certainly already strong enough for 40,000, and that's notwithstanding the fact that that's like a very hot COVID fueled environment where they're trying to convert for home sellers that really don't need the speed, certainty, and simplicity of an Opendoor offer, because they can just list their home the traditional way and get a bunch of offers that weekend. So I think the fact that they were able to reach 40,000 without any help was pretty impressive. But then you add in Zillow, right? The ultimate SEO, Google prop tech type company that has 200 million plus monthly active users. You add in Redfin, that's another 50 million monthly active users. When everyone has sort of accepted the fact that iBuying is too tough of a business, and they've all laced up their shoes and competed and decided, you know what, this game is on a different level than we feel comfortable playing. Then they get to team up, right? And that's really powerful for a company like Opendoor that's still in OfferPad to a certain degree, if they can make these relationships too. But just these other companies that have survived and are currently operating in the area, they really get to benefit from these big search bits type companies lending them their traffic and volume. And so I think the thing I'm most excited about for Zillow is not necessarily the fact that we get a 10x funnel, although that's amazing, but it's really the fact that Opendoor gets to be choosier about the homes that it ends up buying, right? Because if Opendoor is currently saying, okay, if we offer at plus 300 basis point spreads at our current funnel, that's how we reach 10,000 homes acquired every quarter, right? That's how we get to 40,000 homes. But if suddenly we add Zillow's, however many home sellers, to the funnel, then you're in a situation where you can say, okay, now we can ratchet that spread up to 500 basis points, and we can get 15,000 home acquisitions every quarter. Do you see what I'm saying? It's like you keep cushioning the business in a safer way, and yet you can still probably get more volume because of the audience and platform that Zillow commands. And all of these things really compound in a dramatic way, because the more homes you have, the more homes you sell, the more your fixed operating costs are spread between every transaction. And that's what I think Opendoor is really going for. They were going for that escape velocity in 2022 after all the setbacks of COVID. They really just wanted to get to a point where they could be profitable in pretty much all quarters, because they had the scale necessary. And I think now they're at this point where they realize they have to be a little bit more cautious, and that's why they brought the third-party marketplace forward, because of all the near-term macro headwinds.
I can ask another question unless anyone else.
Dave, you are forward right now.
We also have a question from the Discord. Unless Dave, you have a
go ahead. Sorry.
Okay,
go ahead.
So there's one question here from Steven, and he asks, "What is your best guess on OfferPad surviving?" I think we can all agree there will not be a new iBuyer for the foreseeable future, and Opendoor stands to benefit enormously if they are the only iBuyer. 2 versus 1 is a huge difference. How are they looking? Specifically, how's their inventory health relative to their net cash position? Seems on the surface they will be making it, but we just don't have the inventory visibility that you might have.
Yeah,
it's a question.
Okay. Yeah. Sorry, I wasn't sure if you were gonna keep going with that. Happy to give sort of my opinion on what I think about this space. I mean, so both Zillow and Redfin had the opportunity to be the second largest iBuyer in the United States, and both of them, as of yesterday, at least, have bowed out of the space, and that really just leaves Opendoor and OfferPad. And I would say OfferPad has done a tremendous job as an iBuyer to operate at reasonable margins, albeit at a much smaller scale than Opendoor. And I think while, yes, in an ideal world, a single monopoly, like a single company that is doing business, is perhaps better from an offers perspective. I think functionally it doesn't matter so much for U.S. residential real estate. It's just too big of a market. Like you have only 2 companies that currently have a combined market cap of just over $1 billion in a $5 trillion a year industry. I just don't see it as either competition or a headwind for either of them. Like the industry is probably net positive to have both of them in it, because it gives, 1, consumers choice, but 2, also it creates more awareness that there's products like this available. The other thing I'd say is that OfferPad has different aspirations than Opendoor. OfferPad isn't trying to be a category leader. They're not trying to comprise 10% of home transactions in a marketplace. I think they want to build a solid, profitable, but smaller type of business. And the fact that they don't invest as much in R&D and technology, they're more invested in local operations, real estate agents, that kind of thing. It's just not as scalable a business. And so I think my impression is that as long as OfferPad is able to weather this financial storm, that they're going to do just fine. The biggest problem I see is that Opendoor has a lot more cash than OfferPad, and so we might run into a situation where OfferPad has to raise cash, and it could be dilutive, seriously dilutive, if they have to, before they kind of get on the other end of this current market.
We have one more question here from the Discord from Opendoor Bull. He's asking, how do you see Opendoor getting rid of Q2 inventory? Would it just be weekly price cuts, or will they have more realtor incentives? I think maybe, Tyler, we can give him a little bit of an insight what we are seeing in the last few weeks in terms of price cuts and volumes.
Yes, this is a great question from one of my favorite members of the community who is currently listening, and did not ask this question, verbally, but that's totally fine. I think this is probably one of the more exciting parts of the data that we're currently monitoring, because since the summer, we've just been watching embedded margins for this company plummet every 2 weeks, or every week in some situations. Every Wednesday night, Opendoor just cuts prices on X percentage of its inventory and margins go down. What we've seen over the past month is that has stopped. Price cuts are still happening, but at a smaller scale, and new listings and fat margins on newly acquired cohorts are so wide that once listed, they're actually starting to drive up the entire composite portfolio up with regards to margin. And so I think we've begun to see the inflection point for the company. We've begun to see the horizon a little bit with regards to ending this miserable few quarters of underperformance for the company. And the current quarter notwithstanding, I think what we've all been trying to figure out is, when do we get out on the other side of this? And I think we're starting to take those steps in a positive direction, so that the margin is marching upwards, and that'll begin to manifest materially in Q1 and beyond.
We have one more question here from the Discord. I think that's the last one. And the question is, we talk a lot about Opendoor's largest markets, but what trends are you seeing in the markets launched last year? Their stated ramp time has always been about a year, meaning that they should have over 50 markets with a good size buy box ready to transact at scale. Basically, are there any signs of a more diversified geographic volume distribution for 2024?
Yeah, I think it's really hard right now for the company, because the focus isn't really on acquisitions; it's on sell through, and that's been going on for months now. So I do think that it's a little bit of a unique circumstance where, if you'd ask this question in Q2 or Q1, for example, I think there'd be more interesting commentary. But as of right now, some of those markets are completely upside down, like San Francisco, their worst market by far. And some markets are doing just fine, like Detroit, Michigan. Both are pretty small on a total volume level, but because of the sort of characteristic and yet unique macro circumstance of those markets, it's hard to really draw many conclusions. Like, they're still in fix this inventory problem mode, and so I think most of their acquisitions, most of their focus right now is in their major markets that they have the best playbooks and the best playbooks to sort of navigate.
But maybe a few markets that we can call out that are going really well for them, that just recently launched, is New York, New Jersey is going really well, just for it being such a young market. And I think we've seen that Dallas kind of is becoming their third major market. That's something we called out in Q2. Q3 is stopping that a little bit, but it's probably going to come back next year. And Florida has been super strong, and they're growing really well there. And Florida has been one of the markets that's holding up pretty well as well. I think we also posted another chart of all Opendoor sales, the distribution of all Opendoor sales across their markets, and it is quite diversified, right? Ideally, none of the markets would be more than 10%, which we still need to get to, but we're in a much better position than they were like a year or two ago. I think we lost Tyler here. Tyler, you're back?
Yes, apologies.
Okay, perfect. All right, any other questions? Any live questions? I think we went through the Discord questions.
I have a quick one, if you don't mind.
Sure, yes.
Hey, Tyler, I have a question. Just so I've been reading quite a lot of your tweets, your thesis. It makes a ton of sense to me. I know you don't comment on the stock price too much, but to see an opportunity with this big of a total addressable market, that's completely fragmented with a low net promoter score and the ability to have such a generational company, do you find it concerning that, not only are insiders not buying, but they've sold as recently as, like, I think the stock price was about $2.50. I typically don't look into insider selling for various reasons, but it seems that the stock is so cheap with the opportunity so big. Do you ever wonder where the buyers are and why folks internally aren't buying more?
Hey, Will, thanks so much for the questions. I think on the one hand, we would all feel so much better if management and the executive team was buying more shares. I think that would be super encouraging. But there are some caveats to that. One is, I believe that most of the people on the Opendoor team or Opendoor management have the majority of their net worth tied up in Opendoor stock. And the selling that you've seen from insiders recently has all been tax loss selling. So it's all sort of pre-planned in accordance with with their grants. And so I don't think I've seen, at least, I mean, if anyone can correct me if I'm wrong on this, it's not something I paid a ton of attention to, but I certainly check every time that Opendoor files a new Form 4 and one of their executives sells. At the bottom left, there's always a footnote that describes the reason for it, and it's pretty much been exclusively tax loss selling. So I don't think that we can really take anything from that from a decisional perspective. I'm sure that Eric Wu didn't want to sell 100,000 shares of Opendoor stock at $1.50 or whatever he sold it at. I think that these price levels are so depressed that outside of that, there wouldn't be any reason to sell. And if it wasn't for that reason, I think it would be a major red flag for me. But I just haven't seen that ever be the case.
Yeah, totally. And I think you may kind of be like me. Sometimes I'm just looking around. I'm like, what are we missing? Because I've studied the stock quite a bit. I'm going to continue to invest heavily into it, but it's just it seems almost like it seems very clear to me. I think obviously you've been a huge promoter of it, but I just haven't seen other people coming in or talking about it as much. So I'm always trying to look at the other side, what we could be missing. I understand obviously macro events, but you've done a lot of research. It doesn't look like it's going to go bankrupt, but it's priced for bankruptcy. So I don't know. Hopefully we'll be right, and it'll be lucrative for everybody. But it's something I've been thinking about recently, just trying to see what I'm missing.
Yeah, it would be very nice to not be wrong about this, given
Yeah.
the size of our community and how much time we've spent on this. I don't know, honestly, at this point, like for those of us who are invested in this company, we're kind of in it together. And it's been a tough time. Like the entire time that I've been interested in Opendoor, it's been a tough time to be an investor in Opendoor. And sometimes I worry, maybe I'm too close to it, and I have my doubts, and I do the same thing every time. I go back to the numbers. I go back to the thesis. I look at the metrics, and and I look at all the data that sort of we've been able to accumulate on Datador and the research in our Discord, and I always come back to this belief that housing is broken, right? That's fundamental. Housing is broken, and there's no company that's trying to systematically solve the full stack of issues in that housing transaction. And I hope that it's Opendoor that solves it, because some company needs to. Like it's absolutely necessary, whether or not it's Opendoor. But I believe that Opendoor is the company that's going to do it. And even in this really terrible macro environment, I'm continuing to remain invested in the company because I believe it's so necessary that it's changed.
Last question for me, do you have, I don't know, for lack of a better words, an Opendoor hater, right, who you have debated with or has joined these chats? I'd just be curious, because I always love hearing the flip side of a thesis, also just to check myself. Just curious if you've ever done like a YouTube or had anybody on here, but I think that would be really curious just to hear the opposite side of the thesis, just to sense check, myself, yourself, and a lot of folks on this call.
I I would be very interested in chatting with, debating anyone who is coming at the Opendoor iBuying problem rationally. I don't know if anyone has been elected as sort of the king or queen of like the Tesla queue, the Open queue sort of figurehead. I'm not sure if such a person exists. I think there's been a few people in the past, like Bahama Ben, for example, but he made fun of my personality and blocked me very quickly. So that we never able to really have too much of a coordinated discussion. But I'm open to it. I'm very interested in it. It's just rare to find someone who really cares about the space and has researched it deeply and comes away bearish. And so it's hard to find someone, I think, to have a healthy conversation with about that.
Yeah, the happy medium between like Twitter troll and reasonable bear is definitely tough to find. All good though. Thank you, man.
Yeah, thank you. Thanks for the questions.
I think a big problem for the stock itself is also how hard it is to really understand the company. I mean, if you looked at the Q3 earnings, you would see a gap loss of like $900 million, and you would assume that this will continue and they go bankrupt, right? You also would assume that they lost $1 billion of cash if you look on their balance statement. But if you dig into the earnings call and get the context, there's like non-obvious reasons for those changes. Like you really have to go in and do some research, and that's probably not a good requirement for a stock that would reach escape velocity. I think we will see them doing a lot better when it's really clear that they're doing a lot better. And before that, it's gonna be on us to find the truth. We see a lot of big funds being proponents of the company, and we haven't seen any big funds like coming out and saying they're not anymore, they're selling or they're even shorting. I mean, at these prices, it's really hard to short. Yeah, but I would love to get a really educated bear to come on either on the spaces or on the podcast or in any other form and debate these things and go at it line by line. It's we haven't found someone yet. So if you see someone on Twitter talking shit about Opendoor and they seem to know what they're doing, let's organize something.
We welcome that, but even more than like finding a time to talk to a well-educated bear, I'd love to talk to management or hear management talk to anyone. Like it doesn't matter. It doesn't have to be us, but just and it definitely can't be talking to analysts, because I just don't think that that's very constructive. Because that's the I don't know. I don't really want to air my frustrations with the questions on the spaces. I just think whoever management talks to needs to understand the company deeply and be able to sort of coax out the expression or the vision that the company has for what it can be in the future. And in times like these where everything seems like they're going wrong and the stock price can't go anywhere but down, it just seems like the perfect time for management to either buy more shares or go on a call and start sort of doing a roadshow where they just talk about their vision for the company. And I know that they're working really hard and they got a lot going on, but it just seems like now would be the best time to just talk about what they're excited about building and why they're so bullish on swinging for the fences again.
Tyler, have you not spoken with anyone from management, Eric, before?
I've never spoken to Eric before, no.
I feel like, Keith, I'm in Miami. I feel like I've seen Keith interact with you.
I have a question on Phoenix. Can you hear me?
Yeah, we can hear you.
Okay, great. So I know Phoenix is basically their biggest market. I know the embedded margins have increased for their recent purchase cohorts, but I'm assuming they still have a lot of the Q2 cohorts on hand. Are you seeing more of that sell through, and are you seeing the Phoenix market stabilizing? I know they had a very significant drop, and just since they have such a significant position in Phoenix, it's a very big iBuyer market. Just concerned about a potential, another 10-15% drop in the impact on the company.
Yeah, that's a good question. I think, I mean, Phoenix has been bad for a long time now. And Phoenix was one of the few markets where essentially all of their inventory was underwater, at some point in Q3. What we've seen is gradually that number has turned from 100% to 90% to 75%, and it's continuing to get better. But I think it's going to be months until Phoenix is normal again. Well into 2023, and that's part of the advantage of getting diversified and not having one market that constitutes 15 to 20% of your sales. On the flip side of that, the fact that Opendoor operates in 53 markets today means that Phoenix can be bad for 6 months or whatever it is, and the rest of the company performance is buoyed by improving larger margins in those other markets. And so Phoenix is getting better. It's definitely not getting worse. But to your point, if housing were to drop another 10%, any market that they own inventory is going to do very badly, equivalently badly. But yeah, the amount of inventory that they have in Phoenix will just become another 1,000-point negative margin if such an event were to happen.
I think on a positive note, on a positive note here, just looking at the data, the volume is quite stable and a lot higher than what we've seen in mid-July to August when things got really bad. So they seem to be doing well with volume, as well as the price cuts. They slowed down just like we observed it with the general inventory that they have on the market. So it's getting better. They're selling through it, but it's going to take time. It's not getting worse. I guess that's the good news.
Okay, thanks. That's very helpful. And then just on Redfin, I know they commented that they expect next year to be really bad for the housing market. That's one of the reasons that they got out of iBuying. I know we mentioned that volumes are going to be at 40,000 sales for this year. I mean, do we realistically expect that in a difficult environment like next year with higher rates, that Opendoor can continue to sell that kind of volume? I know the Zillow partnership, the Zillow funnel should help, but do we really expect that in a bad market they're still able to produce that kind of volume and cover their overhead costs?
Hey, yeah, I think that's a great question. Can Opendoor maintain volume or even grow in a down market? And what we've seen is that the most negative drivers for Opendoor have been these massive macro shocks, right? Where mortgage rates suddenly accelerated upwards, which resulted in uncertainty about what a home is actually worth, right? Sellers and buyers can't decide what a home is actually worth, which means transactions don't happen. And so that's why for 2 months of this year, in August and July, Opendoor sales volume was closer to 2021 levels rather than 2022. And yet what they've shown since then, with September being their second highest month of sales ever, and then November and likely December being pretty strong months of sales, is that Opendoor's product market fit is probably more aligned to a down market or a flat market, right? Because if it's a buyer's market, right? If buyers are the ones in charge, then sellers need help. And Opendoor's number one product is a tool that helps sellers sell their homes. And so if a market were to flatten out, grow slightly worse or slightly better, Opendoor should be able to maintain volumes pretty easily, especially if they've widened their funnel with Zillow and Redfin, especially if they're starting to add off-balance sheet transactions, which require no funding or capital light, and it'll just allow these massive institutional players with huge amounts of cash to capitalize on dislocations in these markets, right? That's how these companies make generational well. That's how they became dynasties. Is they capitalized on these massive dislocations of '08 and '09, and ended up buying a bunch of inventory. The same thing is going to happen over the next few years, even if it's even if housing doesn't go down as much, or if it goes down even more. That's when these institutional players swoop in. And so I think all of these things are actually catalysts for volume for Opendoor moving forward.
All right, thanks. Appreciate it.
All right. Maybe as a last point, we can talk a little bit about what we are excited about. we talked about a lot of grim things here at the end. Maybe we can end on a positive note. What is the most exciting thing about 2024 that you're looking forward to, Tyler?
The thing that I fantasize about at this point is Opendoor surviving and just growing, just being a normal company that isn't such a battleground stock. That they just get credit for the hard things that they're building, and not so much animosity, so much reflex animosity, right? And so the thing I'm excited about for 2024 is maybe a normal macro environment, right? Like flat, slightly bad, slightly good. Any of those would be wonderful for me, because this is kind of what I brought up at the beginning is there's really only one axis that really threatens Opendoor's existence, and that's fast down, right? And so if 2024 or 2023 can be a more normal, less crazy real estate environment, then the company is really going to shine. And you can get excited about all these other products, Opendoor exclusives, the third party marketplace, and don't get me wrong, I'm excited about that. But at this point, we're in this asymmetric binary bet of, does this company survive, or does this company fail? And so what I'm most excited about is just showing that they're going to survive, and that really sets a stage for them to become this massive, interesting, useful, necessary company that I believe it will.
That's a really great end statement here. Thank you all for joining. For everyone who joined late, we will upload the recording afterwards, so you can watch it on YouTube and listen to it on Spotify. And we're gonna probably do one of these very soon.
Thanks so much to everyone who to ask questions and kind of move this forward. Sometimes there's a bunch of questions, and so it's rapid fire. Other times it's a little bit awkward. So I appreciate you guys for sticking through and listening and asking questions. But yeah, thanks and have a good night.